Hi everyone, today we're going to present the topic balance of payment. So let's start. Since ancient times, trade has been part of this worldwide interdependence we are currently living on. One country economic decision impacts another. So the relevance of this video is to understand how the international economic and financial linkages between a domestic and foreign country works and how they affect business viability. A balance of payment is an accounting statement that records all the economic transactions between residents and non-residents of a country. So basically, these transactions involve the inflow and outflow of money, and the records are for 1 year period. It was also imposed by the International Monetary Fund. It's important to notice that the statement is based on the double entry principle. This means that every economic transaction recorded as credit generates an equal debit entry and vice versa. This principle ensures that the sum of all transactions is zero, so the balance of payment is always in equilibrium. There are three main components of the balance of payment. The current account is the one that reflects the net flow of goods, services, income, and unilateral transfers. The capital account records capital transfers, and the financial account records inflows and outflows of capital. The first and the last are the most important. So the balance of payment reaches the equilibrium when these three accounts add up to zero. As we said, the current account shows four components: goods, which includes exports and imports of merchandise; services account, which includes tourism, financial charges, insurance, and transportation; the income account, which includes investment incomes; and unilateral transfers for pensions and transfer overseas. But how these transactions are recorded in the balance of payment? The exports of goods and services are recorded as credits and imports as debits. In this sense, the exports minus imports is equal to the balance of trade. If this latter is positive, this means a superfluous, and a deficit if it's negative. For example, in this period we had a surplus balance of trade and a deficit current account. Now, the capital account covers all transactions that involve the receipt or payment of capital transfers and acquisition or disposal of non-financial assets. As you can see, the Peruvian capital account was insignificant. The financial account covers direct investment, in which management control is exerted, the portfolio investments, that are the purchases of financial assets with a maturity of less than a year, and other investments shown. Here, financial inflows are recorded as credits and outflows as debits, so we could have a surplus or deficit financial account. For example, the financial account was deficit in the 2018 year. And as you can see, there are other two accounts that are used to complement the balance of payment. Their main uses are to understand the economic dealings of a country with others, such as the United States and China. It is also important for policymakers to formulate and decide on fiscal, trade, and monetary policy statistics, and is used as an indicator to determine whether the country's currency value is appreciating or depreciating. The balance of payment is also used to understand the movements in the exchange rate. The current account balance can be used as an indicator of excess or underspending, and the financial account can be used to analyze vulnerability to external shocks. And finally, the main use is given to understand the linking in the national economic activity. In this table, we're showing the basic identities for the balance of payments accounts. With these identities, we get to this formula. If a nation produces more than it spends, then we'll save more than it invests, export more than it imports, and we'll have more capital outflow. So it winds up with a current account surplus and a financial account deficit. Finally, to conclude, the balance of payment measures the relation between the economy of one country and the world. And it has three main components: the current account, the capital account, and the financial account, which could be surplus or deficit. Its use and correct understanding are vital for the effectiveness of government policies. The last one is a must to be understood for business issues, because the current account surplus is not necessarily a sign of economic vigor, nor is a deficit a sign of weaknesses. Thanks so much.